Okay, here we are starting week 5, where we are covering the adjustments to your gross income, as well as adding on a piece that's not in the text, but is brand new this year to tax law, which most of you have probably heard of by now, the Affordable Care Act, also known as Obamacare. We're going to hit that, and this is one of the best places in the text, I think, to do it, just because this week material is pretty limited, and it's not real difficult, as I think you'll see. The first thing, though, I wanted to draw your attention to this week is when you're doing the tax returns. I'm going to have you submit your answers a little differently than normal. I'm going to have you prepare the Chapter 3 and Chapter 4 tax returns like normal, except you're not going to submit them. What you're going to do is, right now I'm in the class sessions for session 5, and I go down here to the assignments. And what's new this time is we have 2 different tax return options that I want you to do. And we're going to go to the end of chapter tax return, Chapter 3 and Chapter 4. And I give you a couple notes as well on this one. So when you're doing Chapter 4, you follow along on these notes to make sure you've entered in the moving expenses correctly, and for just a little bit of information on the education as well. So when you go into the end of Chapter 3 and Chapter 4, instead of actually attaching your tax return like you did in the Chapter 1 and 2, you're going to answer some simple dollar amounts to let you know how you're doing, to let you know if you got it right or wrong. Then what I'm going to have you do is we're going to go back and we're going to start something new that's different than what you did in Chapter 1 and 2. These shoebox returns from Chapter 3 and Chapter 4 are there to help you understand the tax software as well as you can before actually going in and doing the returns in Chapter 3 and Chapter 4, the ones that are more graded, that you don't have any answers access to. With these shoebox returns, and I'm going to pull up my textbook. If you go to, as it says there, page 3-20, actually 319 is where you start, 320 is where the forms are. Your page will look like this, and then at the bottom of each section, like for the child section, it tells you what your answer should be, like your gross income, what your taxable income should be, what your refund should be. And therefore, you can do a practice return, see how you're doing in comparison to what the right answer should be, and to make sure you're doing everything correctly. And so with these are the ones that I'm actually going to have you send in as a Tax Act file, just to show me that you've done it. That's basically all I'm going to be looking for, and that your numbers match what the book says they should, and what I have gotten when I did them. The end of the Chapter 1s, the answers, of course, aren't given, and you're going to type in your answers. When I may ask, what is line 7 of the 1040, and you'll type in whatever your tax return says for line 7. And some of them, just to kind of make it a little more interesting, some of them I've put on there, and the answer will be 0. Like I may just randomly say, what's line 12 of the 1040? And you'll look down and you'll see business income, and well, we haven't even talked about business income, or there wasn't anything in the chapter about that in the return, and so you just answer 0. So just to make sure you're paying attention that sometimes there isn't anything, their answer could and very well be 0 for a couple of your end of the chapter return answers as you are answering them as you go through. Like maybe line 8B, maybe there really wasn't any interest. And if there wasn't, then you would put in 0 there for the Williams Chapter 3 question. I'm not saying there is or isn't, just that could have been one of the items. So those are the 2 new things this time that I wanted to make you aware of. The tax return, how to submit your answers, and then the shoebox questions, actually just submitting your return. Okay, let's go into our normal week stuff. Let's pull up the notes, Chapter 4 lecture notes. This is the first thing I'm going to hit. And then the second thing I'm going to touch on is the Obamacare guidelines as well, and hopefully explain any of those items that may be confusing. Okay. Let's skip down through, well, couple key terminologies that I think are important to know are, you'll hear this in tax lingo, above the line deductions or below the line deductions. Above the line is AGI. So anything above, on page 1 of the 1040 basically, is an above the line deduction. So if you're looking at a tax return, and I usually go to the one on page 2-3, anything from 23 through 36 would be considered an above the line deduction. And we're going to just briefly hit on some of those today. That's what this chapter is about. Below the line deductions are considered the standard deduction, which is the top part of the page 2, 1040. So we've got the standard deduction, or what we're going to talk about next week, your itemized deductions. There's lots of different examples of what's itemized and what's not. And your personal exemption would be another type of a deduction called below the line. And then there's the credits, which fall even further down, and we'll talk about that in 2 weeks when we get to week 7. Again, we're in week 5, covering the above the line deductions. Let's go down here to moving expenses. A couple of key things that have to occur for you to take moving expenses, and then also I wanted to bring up the Tax Act, what you have to do on there to make it work. So as long as you meet these 3 items here, you can take a moving expense. Some people think they can take it if they just move households, maybe across town. That doesn't work. You don't have to change jobs, but you do have to change job sites. So I could still work for Ivy Tech, but maybe I moved from the Anderson Muncie campus and I switched down to the, say, Evansville campus. That would be okay. You don't have to change companies, just sites. And as long as you are at further than 50 miles more than what you currently drive, basically. So if, say, for example, I live in Anderson and I drive to Muncie, that would be about 20 to 25 miles. I would then, if I moved down to Evansville, that the distance would be, okay, from your current, let me start that back. The 50-mile test. Okay, so as long as your old house going to, well, let's just read it. I think that'll probably be easier instead of me trying to give an example. And my example here, I think, is probably the most concise that I can think of. So, employee lived in Anderson, like I was saying, and in this case, let's say the job was in Indy. It took him 47 miles to get there. And that new job is now in Evansville, like we had said. And from your old home to that new location in Evansville would need to be more than 97 miles, which is your old distance plus 50. If it's not more than 50 miles more than what you originally drove, you wouldn't be able to take the moving expense. So if you do drive from Anderson to Evansville, it's definitely more than 97 miles, so it would qualify. So again, I think this should help explain what I'm talking about to make it the most concise. Anderson to Indy would only be 40 to 50 miles. Anderson to Evansville would be more in the range of 150 miles, 200 miles, so definitely more than the 47 plus 50, which is what the rule requires. Old distance plus 50 more. What you're able to deduct, you're able to deduct any, like a moving van or any rental company that you may hire. That would be okay. You would be able to deduct your traveling from Anderson to Evansville at 23.5 cents a mile. But you can only take that once. So if you took your multiple trips, you could only take one trip and actually deduct it from mileage. Notice you're not allowed meals. And maybe another one that is actually kind of necessary, but you're not allowed to deduct it, is the house hunting. You go down there looking for a place to live. And any temporary living expenses wouldn't be included either. Okay, we're going to talk about this health half of self-employment tax when we get to the business section, which is after the semester break, or after the spring break, halfway through the semester. But what this basically is if you have your own business, you not only have to pay the self-employment tax, which includes the Social Security and Medicare. Everybody has to pay that when you're an employee. But if you own your own business, not only are you the employee, but you're the employer, so you have to pay both sections. Whereas if you're just an employee, say me here at Ivy Tech, I pay the self-employment tax, which is 7.65%, and Ivy Tech pays the other half, 7.65%. So together it's 15.3. However, if you are self-employed, you pay the entire 15.3% yourself, which is, in my opinion, a little unfair for those who have their own business. You have to pay both sides, you and the employers. One other thing on here is the self-employed health insurance. I wanted to bring that up. Self-employed health insurance, you can only take that as a deduction on the 1040. The bad part is you can't take that on the Schedule C that we're going to talk about when we get to the second half of the semester, business income and expenses. When you pay for your own health insurance through your company, you aren't allowed to deduct that as a normal business cost, even though you are allowed to deduct your employee health insurance premiums, just not your own and your family's. You can only take it as a deduction for the on the 1040. And then you may ask, well, what's the difference? I get to take it one place or the other. The big difference is for the half of self-employment tax. This half of self-employment tax is on your net income for the business. So if you can't make a deduction on your business, say for that $1,000 of health care premiums, then you're going to pay 15.3% on that $1,000, where if you could take it as a business deduction, you would be able to take that $1,000 off and not have to pay the 15.3%. So that'd be an extra $153 that you're having to pay in taxes, just depending on where you get to make the deduction. Again, it's not good for the business people. They have to take it after net income once it's already on the 1040. So they are having to pay the self-employment tax at that, say if it was $1,000, that full $1,000 that they cannot use as a deduction. Alimony, I'm not going to talk a lot about this just because Indiana is a non-alimony state. Just note that alimony is deductible if you make a payment. If you receive alimony, it is taxable. The difference being then is child support. Child support is not taxed. However, it's also, so if you receive it, you don't have to pay taxes on it, but if you pay it, you don't get to deduct it either. It's a big difference between alimony and child support. We spend a whole week right after spring break on IRAs, so again, I'm not going to touch on this a whole lot. Just knowing that the basics, how much you can deduct per person if you wanted to put money away into a retirement account. There are limitations to this if you already have access to a retirement account, but again, this is the bare basics. A big one for this chapter is the student loan interest deduction. If you take out loans and then later on after you're out of school you start paying back these loans, you can take up to $2,500 off of your income as student loan interest deduction. But the bad thing is this is the same amount whether you're single or married. So this is one of the few items where there's still somewhat of a marriage penalty, in that if you had two single people, they could both take $2,500 off of their taxes. However, if you're married, the two of you together can only still take $2,500 instead of being double, which most things are that way for married filing joint now. This is one of the few exceptions. If you're still dependent, you can't take this deduction, so if you're paying back a loan and you're still dependent, you can't take the deduction. Here are the phase-out limits that are important, and since this is one of the first times we're actually doing phase-outs, I'll take a couple minutes here and go through how at least I work them. How I work them is a little bit different than how the book tells to work them. You get the same answer, it's just with my way, there's only one step. With the book's way, there are two steps. I always like to do it with the least amount of steps as possible. So I'll quickly explain. If you fall within this range, if your AGI is within this range here, then you cannot take all $2,500. If you're over $80,000, you can't take any. And then the married filing joint range, notice how it's double, which is pretty typical. Again, this is the only number, the 2,500 limit, that is one of the few things that isn't double for married filing joint. So when I give a little example here of $70,000 for somebody who's single with an AGI of $70,000, and their student loan interest is $2,800. I know already that they can't take the full $2,800. The most they can possibly take is $2,500. And then I also know that they're going to be limited on that $2,500 because they're over the smaller of the phase-out number. So the formula that I use is I take, okay, the top phase-out number for that category, 80,000, subtract out how much we had, 70,000, and then divide by the span meaning how much from the low end to the high end for that category, which is, in this case, 15,000. So if I take 80 minus 70, that's 10,000. 10 divided by the span of 15, that leaves me with 2/3. I can only take 2/3 then of the top number that I'm allowed. Notice the top number is 2,500. Even though I had 2,800, I can't use 2,800. The most I could possibly use is 25. So 2/3 of 2,500, I would be able to include the 1667 on my return as a deduction on line, when we go down to line 33, student loan interest deduction on the 1040. And then I give you another example here. 145,000 AGI, so you take your top number minus the 145, divide by the span, so 15 over 30, divided by, again, your interest, or, as I have here in my little formula, the total allowed amount, which is 2,500, the lesser of the total allowed amount, or what you actually paid. So the lesser was what we actually paid, 2,100. So we can take a 1,050 deduction. A couple items you should know about who can take the deduction, so definitely read through that. The tuition and fees deduction, you are allowed to have that. That is one thing that was renewed through 2015. Basically everything was renewed, even the top item up here, the educator expenses, that was renewed as well. So what you can do here, the tuition and fees, as long as in addition to what we'll see in a little bit, or in a couple weeks, is you're not allowed any room or board, or books is another one. No books for this one, or the lifetime learning credit, which we'll see in a couple weeks. The only thing you're allowed is tuition and fees. There are some limitations definitely, and I've estimated that probably only about 5 to 10% of people who have education expenses, this one is their best option. It's not the best option by far. There are a few instances where it is good, but again, that's kind of far and few between. But I wanted to let you know that this was what this was here. Okay, before we look into the tax return, I wanted to go through the Obamacare. So here's the Obamacare guidelines. I just recently put in a couple things in red that I thought were maybe the more important items in the section, since this is kind of harder to read. Just there's not a lot of breaks in there. If anybody is possibly looking at the premium tax credit, the only way that that's available is if you got insurance through the marketplace. One key item: everybody is required to have health insurance for every month of the year. There are some exemptions that we'll look at in a little bit. Scroll down to page 6. This was kind of a brief overview, basically, of what everything up above was about. So if you read through it, you'll see that. All right, so what's it mean exactly for the shared responsibility provision, this Affordable Care Act? So you either qualify for an exemption or you have to have health insurance. If you don't have either of those two, then you are going to make a shared responsibility payment. And we're going to talk, the payments are right down here. And you'll notice that they go up quite a bit from year to year. And then in 2016 they start to, or 2017 they'll be about the same as 2016. But for this first year, it's $95 per person, or $47.50 if you're a dependent, or child, I should say. However, it's the greater of 95 or 1% of your household income. So a lot of times it could be the 1% definitely that comes into play, and not just the $95. So if somebody has a penalty of $130, you could say, well, it's probably because they had the 1% of their income was higher than the $95 was. The 2015, notice that the amount per adult skyrockets to $325 as the minimum number, or 2% of your household income. The final number is up to $695 per tax rate for your return. And then every other year after that will be very similar, go up just a little bit with inflation, like all the other dollar amounts do. One key item that I definitely want to bring your attention to is if you claim somebody is dependent on your return, they better have health insurance, or else you're going to pay a penalty for that individual. So bear that in mind. Basically, what you could do to avoid the penalty is just not claim that individual as a dependent. Would be a way around it. Household income. What is exactly household income? We're going to talk about that in a little bit. But go through a couple of these scenarios. I don't want to take the time to do it. I think you can read through these just fine. Again, I want to point out some of the most important things. This is again showing that if you claim somebody as a dependent, you need to have insurance on them. Otherwise, you will have a shared responsibility payment for that individual that you've claimed. What's minimal essential coverage? Well, we can look through these, and basically if you had insurance through your company, like you have for the last 10, 20, 30 years, not a problem, you are covered. The key thing, and then we can look at some of these retirement covered. If you have Medicare, that's fine. So here, Medicare Part A coverage. Big one here that I see a lot through VITA is Medicaid coverage is fine. There's lots of different types of Medicaid coverages out there. Basically, the ones to look through is the ones that are not considered essential coverage. So you know these are the most common ones that the IRS has found that are not considered essential coverage. Okay, I told you about this. If you don't have insurance, you could be claimed as exempt. You have to have these items to be claimed as exempt. You have to have one of these. If you have unaffordable coverage, you actually take the exemption on the tax return. You don't have to have anything special from the marketplace. This is an IRS exemption. This one as well is an IRS-related exemption. If you just had 2 months where you didn't have insurance because you were in between jobs, that would be considered fine, and you don't have to pay any fee on that. This is the only other one that the IRS has available as its own exemption, and I can show you this on a tax return, how this works. On our Tax Act, I'll have to go through it because mine was just updated not that long ago, so it wasn't showing up on mine yet. But the tax return we use for VITA, I could easily bring something like that up, and I could show you how that works. But again, it may not be worth it since you're not used to that type of software. Certain non-citizens, if you were members of a health care sharing ministry, it's not just anybody in that they claim that they're whatever religious affiliation that they should be exempt. That's not the case. You have to be a certain member of a certain religious organization to be included in this, or a religious sect that has been in existence since 1950 and as recognized as conscientiously opposed to accepting insurance benefits or any type of benefit. So if you are out there and you think, I don't want this, but I also like to go ahead and keep my Social Security, that doesn't work. So most people are going to be included in this. You can read through the advance payments, the credits, if you have them. Basically, you could call into the marketplace to call and see if you don't have insurance, what it's going to be with your income level, how much you're going to have to pay a month. If you decide to pay the full amount, you can get back a premium tax credit then on your tax return at the end of the year. I mean, really, it's better to go ahead and take the credit throughout the year and not pay as much. Go ahead and take the payments that they're giving you and just come out even at the end so you don't get a credit, but you're also not paying as much throughout the year. And then the last thing here, what are the poverty levels used for? I go through here, and basically if you're under 400% of the federal poverty line, you are eligible for getting some help on paying for your premiums. And if we scroll down, I give you some of the poverty lines, depending on, say you have 4 people in your household. If you have less than $95,000 of income for that whole household, then you would be eligible for some assistance in getting the marketplace premiums paid. So you can look through. I think that chart was kind of nice to know. Okay, I think that puts us at about the half-hour, 40-minute mark, and that's where I like to try to keep us at. I'm probably not going to go through where the things go on the 1040, except knowing that when you're filing a 1040 on the back, on line 61 is where if you did have full health insurance, you would click that box, and then you don't have to do anything else. If you didn't have full health insurance, then you have to file a form, and the form number off the top of my head I can't remember, but I believe it's in here somewhere. It's so new. It comes up on our software that if the person does not have full health insurance, it pops up saying you need to fill out this particular form. Again, if it's important, I can definitely find it for you. You can just ask, but off the top of my head, I don't remember what number form that is. You would fill that out if you didn't have health insurance for the entire year, if you only had it for partial or none, and then you've got to put in the amount of the penalty. Okay, we'll sign off here and look forward to if you sending in any of your things you want checked. We'll definitely check that if you have it in by Friday, 8 a.m.